The Fed has decided.
You are not important, sir. We're going to start this thing off with, oh, no!
I see the sabotage. This is how you guys welcome me back. Shame on both of you. Guys, welcome back. Welcome me back. I am excited to be back. Oh, man, the Fed just announced they are not changing the rates. How are the markets reacting in real time?
Stupid.
Why is it
stupid?
Why is it stupid? Why is it stupid?
Does it cost a lot of money to borrow?
Inflation's going down.
It costs a lot.
Inflation's
Can't borrow money.
Okay, we're gonna have that conversation.
I want to refinance my car. Actually, I got a decent rate, but it'd be nice to go down a little bit lower.
Wow.
And I'd like to borrow some money, man. You know what? Because we live in this great country that lets you irresponsibly borrow way too much money. I like to borrow money and buy crypto.
Wow.
And then flip it. Sometimes I lose money and regret it. But most of the time, it's a good move.
Is that a sign with the dice 6-1? Does that mean Bitcoin's going to $61,000? Well, Bitcoin, you know what? Let's take a peek at how have the markets reacted to an unchanged Fed rate. They haven't reacted. I guess Bitcoin is up 1.1% over the last 24 hours.
Breaking news.
We saw, when we did the show yesterday, we were about 1,000 off of where we're at right now. We're at like 65.8, I believe, 65.7, 66.5. And so, you know, a lot of people are still, they tend to forget how the markets work, right? You shared a post yesterday. Out of the 12 or 13 years that Bitcoin has been trading from $11, only 2 years have we seen explosive price movement. The rest have been sideways or down. So, guys, we got to keep that. We got to remember those things, right? I know it's boring right now, but last thing you want to do is been holding through the bear market 2021 all the way now, and then just all of a sudden give up, throw in the towel, and say I can't handle anymore. That would be the dumbest mistake you could ever make. One that you'll look back on and regret 10 years from now when your friends ask you, "Hey, didn't you at one point have a lot of Bitcoin?" Yeah, but it wasn't doing anything for 6 months, so I sold it. Don't be that person. Don't be that person. Let's take a look at how the traditional markets are reacting. Also, we will be covering the Fed, Jerome Powell's press conference live on the show, so don't go anywhere. We'll also give some of our commentary, but you take a look here. The traditional markets are looking really good. NASDAQ is up 2.31%, up 400 points on the day. S&P 500 is up 1.5 points, 1.5 percentage points on the day. Dow Jones is up 0.5 percentage point. And oil is up 4 points, not very good. And so that is in the United States. And you can see here commodities, they're up mostly with the exception of natural gas. And you can see all the treasury stuff here. But yeah, markets, I guess something we're expecting. We take a look at the CME, right? What was the CME expecting? 97% were expecting this exact move. Now, what was the, what did the Fed say? Well, they said progress is happening on inflation, right? So Fed holds rates steady, but notes progress on inflation. They said they're holding short-term interest rates steady, but indicated that inflation is getting closer to target, which could open the door for future interest rate cuts. We take a look here for the September 18th meeting. 90% believe we're going to see a 25 basis point rate hike. So, what are your thoughts, Robin? Are you surprised? Are you sad? Are we screwed?
We are.
No, we're not.
We are, man. Hey, here's the thing. Like, we still are at 5% or 5 to 5.5% interest rate, substantially higher than we were last bull market cycle. And, you know, I'm just looking at it from an investor perspective. And, you know, the reason they even raised the rates was to suppress economic activity, was to draw us as close to a recession as humanly possible without flipping the boat over. And honestly, it's not favorable news if you're looking to invest, right? If you're looking at the stock market, if you're looking at market activity. Now, we are post-halving, so I was hopeful that, hey, post-halving, we're going to be in a scenario where we're going to get rate cuts, plus the halving, plus surge of liquidity through the ETFs. And it's all put on pause, right? When's the next meeting? What was
September 18th.
September? And so, guess we'll just wait another month and a half, almost 2 months, for the next possible rate cut. Hopefully, it does come down the line. But even then, it's gonna be slow moving, right? They're gonna do what, 0.25%? You would assume, right?
Yeah, quarter.
Yeah, it's not gonna be
unless something just.
So yeah,
Right.
I mean, even then, it's not ideal. I'm curious to see if they do get a change in the executive branch, if we do get a new sitting president, which we will get, either it's Kamala or Trump. But
Are you part of the White Dudes for Kamala group?
the white dudes,
Yeah, there's a group. They did a Zoom call. You didn't see that?
I thought it was 1,000 white ladies.
No. White Dudes for Kamala. Zoom call. Were you on that Zoom call?
No. I saw the one with the it was like 10,000 white ladies for Kamala.
White women for Kamala.
Yeah, which is interesting. The polls are coming in, and they're saying that Kamala's tightening up the race with all of these swing states. So the 7 swing states, apparently, it's a very narrow position between who is leading there, and so we might not have that. Hey, looks like Trump is going to win. Not, at least not in the polls aren't reflecting it. Now, this wouldn't be the first time this happened. We had the polls when Trump was elected as president the first time around, where Hillary was deemed the winner, and nobody was going to even contest it, and nobody even believed. I don't think even Trump's camp believed that he was going to win. And then, lo and behold, came in with a sweeping victory, took the election. I'm just curious to see, where do we fall this time? Are we going to see another scenario where it looks like Kamala's going to win? Because we know that the media will paint out the Democrats as favorable, or at least a high likelihood to win. And it makes me even think, like, when they were saying that Trump was going to get removed, was down in the polls, do you think they did that? Because we know the media is influencing politics, right?
No, they don't. The joke.
So, and with that said, I mean, did they want to boot Biden out? So basically, there was a political hit put in on Biden, and they framed him to lose it, that he was losing, and then lo and behold, in comes Kamala. I don't know, man. It's very interesting. I'd be very careful to believe anything from the media when it comes to the politics and who's winning the race, but.
You also got to look, like, who do they poll? A lot of these ones that show her up by a lot is out of 1,000 people polled, 700 were Democrats. Like, obviously they're gonna
they do, and they do poll a very small amount. You would think with these polls,
we polled 2 people. Kamala's 100%.
Got a guy at the drive-through at In-N-Out Burger on Lake Mead, and the guy that served us my dishwasher last week. Now, like. It's interesting. All I can say is that, I'm not deep root political. I'm not over here beating this Democrat and Republican drum as like, hey, you have to vote this way or another way. At the end of the day, I'm more of a candidate voter. I look to see, hey, do you align with crypto and my values? And if so, I'll vote for you. More times than not, it tends to lean in the Republican side, but. The thing is that with Kamala, I'm not seeing any progressive crypto talk, right? She had an opportunity to go speak at Bitcoin Nashville. Nope, didn't go. Now, it was short notice, so whatever. But she's had many opportunities to come out and speak out and voice her position when it comes to crypto, and she has yet to do that. And so, like, if you are in crypto, if you have a portfolio, I mean, there's one, you have the Biden administration who has vetoed the last bill. They've also increased capital gains tax. So, hey, you know what? Cash in some crypto, it's going to cost you significantly more than it did prior to the Biden administration getting in office. Obviously, we've had nothing but the industry being pushed out of the United States. Every exchange has been under fire. Doesn't matter if you're publicly traded. Doesn't matter who you are. All of them have been attacked by the current administration. And so for me, for being a crypto person, like, how in the hell am I supposed to get behind a candidate that has not only not taken a positive position on crypto, but has been actively trying to destroy it. Now, yes, she wasn't a sitting president, but she's number 2. And you know what? It looks like Joe Biden's asleep at the wheel and somebody's driving that damn bus, and maybe it's Kamala.
Probably not. But she does know how the bus works. The wheels turn, which makes the bus go forward. Now, Ashley, I'm curious. We have Ashley in the studio today.
Yes.
Were you on that white women for Kamala call? Or?
No, I didn't
No?
even. What was that?
We don't know. It's just a call.
Okay.
Yeah, they're trying to bring people to vote for her.
No, I wasn't on that.
Setting up a lot of Zoom calls. She had to upgrade to the premium version too, so you
Ooh.
can stay on for more than 20 minutes.
Wow.
Anyways,
That is so sweet.
Yeah. So I do want to go over this. Rate cuts, easy monetary policy, right? We would talk about what happened in the last cycle. Everyone got airdrop money, and people stopped paying mortgage. People stopped paying rent. There was little periods where you didn't have to worry about that because of obviously the pandemic, everything's shutting down. So people had all this extra money to dump into the crypto markets. We saw massive rallies in altcoins and meme coins, and of course, Bitcoin getting to a new all-time high of around $69,000. Well, we know that's already kind of happening, right? We saw the M2 money supply start to increase again. And now we have this. The Treasury increases their liquidity buyback total to $30 billion. What does this mean? There is not enough people on the open market that are buying their shitty notes, their shitty bills, and their shitty bonds. So what do they have to do? They got to print money to buy it themselves. It's called a flywheel scheme. It's also called not a Ponzi scheme, but we print money and then buy your own product. It's called dog eating your own dog or something.
It's like writing yourself an IOU note. Like, oh man, I can't make today's bill. I can't make today's mortgage payment. Hold on, IOU to Robin.
I borrow money for myself.
To Robin from Robin. I will pay that later. Put that in the pocket. Like that sounds dumb. And that's literally what
We got to keep it going, bro. We can't let it collapse and crumble.
Welcome to the United States government. And so then when you go to your mechanic and you're over there bored while they're just changing your oil, and you're over here talking about Bitcoin, they're looking at you confused and they say, well, I mean, I don't understand how Bitcoin works, so I'm not going to get into it. Like, do you understand how the monetary system works? Do you understand how dollars work? Because I barely understand it, but what I do understand is that there's smoke, mirrors, and all kinds of shady behavior around. And I just, if you had 2 jobs and one was a salary, right? One was a salary, and you're like, hey, look, the salary is $80,000. But at the end of every year, we're going to cut that down by 20%, right? So you're going to make, 6,000 something. 60 something thousand next year, and the next following year you're gonna make 50 something thousand. You would just be like, hell no, I don't want no parts of this job right now. I'm not gonna stay here. Why? Like, well, I could work here for a year and then leave before they cut my salary. That's how inflation works. Now, if you had a job where you're making hourly and every say 3 months you're getting a raise and you're making more and more money, that's Bitcoin, right? And so that's how the monetary system lines up right now versus a tangible asset that has a fixed supply like Bitcoin, right? You stay in a salary, you keep losing money every single year, you're getting paid less. That is how the dollar works. And it's not getting any better, man. It's not getting any better.
In fact, it's getting worse.
Yeah.
Getting a lot worse. I know you talked about yesterday, El Salvador trying to settle payments in crypto with Russia because they can't use the U.S. dollar.
And so Russia has made a framework for Bitcoin payments for international trade.
Yeah.
Same time. So is it a coincidence that El Salvador? No, it's not. It's obviously not a coincidence. So El Salvador's basically in talks with Russia saying, hey, look, y'all wanna trade Bitcoin because we're not allowed.
We need to import some of them bears.
And then and bears, yes. Do they have bears in Russia?
Every Russian video I see is like a Russian dude in the snow with their shirt off and a bear playing around like hide and seek.
So,
weren't you married to a Russian? You should know more than I do.
Was.
So
the Russians came out Putin came out and they said, like, look, we're gonna start taking payment in Bitcoin for commodities for trade. Happens to be the same week that El Salvador, who has a dual currency, they use crypto, aka Bitcoin, also the dollar. You can't trade in dollar if you're going to work with the U.S. So there you go. This is something we're going to see a lot more of. We have sanctions in Iran, also North Korea, and lots of other places as well.
We have an alliance with North Korea, said Kamala Harris. Now, I do want to, you brought up earlier when we came into the show, we talked about the Fed rate cuts and yay, it's going to spur the economy. I don't think that's going to happen. And I'll tell you exactly why. You look at the chart from the Fed, right? The Federal Reserve, I think it's St. Louis. Yeah. And credit card delinquencies have been up and to the right. People's credit scores are in the shitter. People are over leveraged on debt. And people haven't been able to get approved for anything at these current prices. They're definitely not going to when the prices are low either. So you're going to have a few people who are able to keep their head above water, who don't have more than a 30% debt to income ratio as far as when you look at your credit score.
Retail is screwed. But the economy, I mean, majority of the money is held by a smaller network of individuals, both institutions and very wealthy individuals. And those are the people that really control the money supply. And they don't make moves when interest rates are high. So when interest rates start getting or cutting, and the smart money out there needs to protect their money. They need to accumulate more money when they are incentivized to borrow, and they need to hold on to their wealth when the economy goes through a bubble scenario or a pullback. And so what we're seeing here is that the retail is screwed, right? Until we get into a scenario where the government acts in a reckless manner to address some kind of global geopolitical or economic situation, we're not going to see the retail come in, at least not per handout through the government. But what we are going to see, and what we've seen historically, with the exception of 2021, was that the government's going to ease up rates. They're going to incentivize borrowing. They're going to do quantitative easing. They're going to inject the smart people, or the smart institutions and the whales with endless capital, and that's going to spur the economy. And then it's going to widen the wealth gap, and retail's going to be screwed. Now, we could see a scenario where, hey, all of a sudden, U.S. goes to war with somebody. I don't know, some banks start to collapse. All of a sudden, they just start throwing tons of money at the banking system, and that trickles down. I'm not exactly sure what it'll look like, but retail's you watching me? We're screwed, man. I hope you have a business. If you have a business, well, hey, man, you know what? You'll be all right. But if you don't, then that's why you want to protect your wealth in assets like Bitcoin and altcoins, because that is really your only safe haven, right? It's the only thing you have. The smart money is going to position themselves, and they're going to take advantage of the government's policies. You aren't privy to those unless you have a business. If you don't, then, hey, you know what? Buy some Bitcoin, buy some ETH, buy some Cardano, some Caspa, which we got a video coming out today.
You mentioned business. If you have a business, or maybe you want to start a business and you're just not sure of certain things, Legacy Academy has got you covered. Today's show is brought to you by Legacy Academy. 50,000 downloads since they launched, I think, 2 weeks ago. Absolutely amazing. They're ranked towards the top for educational apps on the Apple and Google Play Store. So big shout out to Legacy Network. We are honored to have him on as a channel partner. But why did I bring up business? Business is one of the modules you can take to learn. Maybe it's, hey, I don't know how to manage my time with my business and my family. They got you covered on that as well. Fun playing games. They give you daily rewards. So if you haven't downloaded the Legacy Academy app, I implore you to do so. It'll be worth your time, I promise you. And once the token goes live, you'll be able to earn money doing that as well. Speaking of money, this man is a money printing machine. Donald Trump decided to launch Bitcoin sneakers, and in 2 hours after, he sold out. 1,000 sneakers, 5 of them were randomly autographed, and it's sold out. But it's interesting. Bitcoin president, or Bitcoin, but then it says crypto president. This has the maxis in an absolute whirlwind. You know, I watched his keynote speech at the Bitcoin Nashville conference. I was expecting more. For me, it was a little subpar, but I also didn't have the live at the event, the crowd and the excitement there.
It was very energetic, very inspiring. And you know what? If you were expecting him to come out here and start talking about smart contracts and tokenizing real world assets and, you know, how he's using Uniswap, don't kid yourself. I mean, the man probably, there's rumors out there that he has someone write emails for him and read emails because he doesn't understand how it works. But no, I mean, that's hearsay, that's speculation. But the thing is that he sees that it's what I took away is that he sees that it's an emerging industry. He likened it to the steel industry in the 1920s or 30s and how it was going to revolutionize the industrial era for the U.S., and which it did. And you know, the U.S. really was just a nation that was starting out with a booming population. And then came the innovation, the Industrial Revolution. We had our factories where we had Ford with the first assembly line. You had the steel buildings going up, and so a lot of technology was really just fostered and nurtured and was started here in the U.S. And that really kicked off the Industrial Revolution. And so we are in a financial revolution, and we haven't had a change, well, since what, the Dutch era, right?
Dutch era.
I mean, it's like 1600s, 1700s. And so, you know, we have a situation where we have fiat currency with nothing backing it that's bleeding off at an ever growing faster pace. And you know, it's transitioning from a government system to a private-led system that's also decentralized. And whether or not the governments want to fight it, some of them will. Some of them have tried. Some of them have failed. Some of them have, well, delayed progress in our industry. Or the U.S. is a prime example. But
I don't know if you do this on purpose, but some of your segues are just so good. You mentioned governments and fighting.
What you
got? You know, the president of Venezuela, Nicolas Maduro. A lot of speculation, and they fixed the election. He didn't really win. And Elon Musk has been posting, and he took away Maduro's official government check. You know, they got that silver check where they're like government official. He took that away. And so this was Nicolas Maduro. Just read the subtitles.
Elon Musk, quien se mete conmigo, se seca. Quien se mete con Venezuela, se seca. Elon Musk. ¿Quieres pelea? Vamos a darle, Elon Musk. Estoy listo. Soy hijo de Bolívar y de Chávez. No te tengo miedo, Elon Musk. Vamos a darlo, pues.
So he just challenged Elon to a fight, to which Elon said, I accept. So now he's going to fight Mark Zuckerberg and the former and speculated president of Venezuela. So very interesting there. Speaking of fighting, Sam Bankman-Fried has been fighting our industry since he got in. Listen to Cantor Fitzgerald's chairman talk about what SBF did, Robin, in 2022. Listen to this. This is from Bitcoin Nashville.
So I'll give you an example. In May of 2022, Sam of FTX had obviously done a deal with Circle, right? And he sought to try to destroy Tether. So he amassed huge amounts, $10 billion of USDT. And then in May of 22, redeemed it all in 2 or 3 days because he assumed they wouldn't have the liquidity. But we had not announced to the world that we were holding Tether's treasuries yet. And we met 10 billion in redemptions instantly because it's no big deal for us. We deal in trillions of treasuries. It's nothing for us.
You know what that tells me? That tells me that as we move forward and we continue to see companies like Cantor Fitzgerald, banks like BNY Mellon, JP Morgan Chase, Bank of America, other large institutions, BlackRock. This like $5 billion of outflows, of selling, of, oh my God, this $30 billion ecosystem went down, the entire crypto market's down. I think those days are waning. And you heard it from this man right here, right? We deal in trillions of dollars of treasuries, of reserves. 10 billion is nothing. And that is the direction we're going in. And to me, that was the biggest thing I took away from that. Also, that Sam Bankman-Fried is a piece of crap. Any takeaways for you?
He's a piece of crap.
I want to say, well, he's a piece of shit. Yeah.
Ah, there we go. No, it's interesting. That's what you're gonna get with large asset managers, these big financial institutions. They have so much money that whatever the crypto degens think is cute that has worked in the past probably not going to work when it comes to trying to muscle your way around these large asset managers, right? You're not going to go toe to toe with BlackRock, for example, and be like, hey man, I'm about to short the crap out of this. Watch out, BlackRock, I got you. Like, no. And so this is where we're getting. So there are some trade-offs getting large companies and large asset managers and the big money in traditional finance. There are some negatives, obviously, but I'll say that there are positives as well. And well, for market manipulation, it's hard for a smaller crypto company to go against some of these institutions that have been around for hundreds of years. To circle back to the Venezuela, I did pull up this very interesting chart. So this is the inflation. This is an inflation chart for Venezuela since 2014. You can see this giant this giant candle here. So here is the inflation per CPI for Venezuela. So in 2019, this is percentage numbers, by the way. You had 19,000% inflation. In 2020, you had 2,300% inflation. 2021, you had 1,500% inflation. And 2022, you had 168% inflation. And in 2023, you had 337% inflation. And so if you are the sitting president and you've been in office for the last 6 years, and these are the numbers for the last 5 years, where the headline number was just shy of 20,000% inflation, that's what hyperinflation looks like. It means you cannot use financial services, period. Other than maybe a bank account where you can draw and deposit. Outside of that, you cannot take loans, you cannot buy a house, you cannot buy a car, you cannot finance anything because you cannot forecast the price of a currency out more than, say, a couple months. And so that is what it looks like to be part of a country where you have hyperinflation, the direction that it seems like we're trending towards. I don't think we'll have anything quite as dramatic as Venezuela, but it just shows you like who would you want as your president?
Jerome Powell is live.
What's he gonna say?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
Boo!
We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, Bitcoin just flipped green. Let's go. Okay.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium. Why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as we're actually in a good place here. We're balancing these two risks of go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's That's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now of thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's.
So more of the same here from JP, right? We need more data. We want to see how it goes. The economy's doing good. And GDP numbers. What a lot of people forget is part of the GDP numbers is government spending. And we just surpassed $35 trillion in national debt. So we know the government spending. We saw those buybacks from the Treasury. And so that's going to have a big weight on the GDP, right? It could even, and I haven't dug into the numbers, as deep as maybe some macro analysts have, but I can probably bet you that a majority of the GDP growth is due to government spending, right? And inflation. People having to spend more money at the grocery store. People having to spend more money on gas. It's not because they want to. It's not a true pulse on the economy. Oh my God, people are spending more money on vacations. They're buying more flight tickets. They're spending more money on dinner. No. Spending more money on car insurance because they have to. Spending more money on groceries because they have to. On gas because they have to. And the government because, well, they want to. So that's all we got for the show today. Any parting thoughts here, my friends in the studio?
I love Jerome Powell.
Yeah, so exciting, right?
Yeah.
Real exciting. Anyways, make sure to come back tomorrow. We have Adam from Radix joining us to share some exciting updates to the Radix DLT and what's happening in the ecosystem. And with that being said, Rocco, you missed that tornado, didn't you? I saw you yesterday. You were so off cue with the tornado in the outro, Robin. Shame on you. Thank you so much for tuning in, guys. We love you. On behalf of all of us here from Sin City Crypto, we'll see you tomorrow.
Sin City Crypto. Everybody know we here for. Entertainment and info, gonna show you how to get that big dough. So every day stay tapped in, for big facts, no capping. With Bitcoin, if you're in, then you win. We divide the pie with no fraction. It's Big Rob, David, I spit the game, but they gave it. Named according to your favorite, I got dry powder, why save it? To the OGs, new beginners, special shout out to the well members. Buy the dip, sell winners, ain't really nothing you can tell sinners. Tune in for the latest new flavors, they gonna teach us mean coins. They polarizing like barbecue chicken pizzas. I laugh with a major grin. Laggers, we trade them in. Baddies, they came to sin, and sinners gon' play to win. Screaming hola, till my bags are flowing over. Hold ya, to the moon, then to the solar. Won't I? Don't be letting FOMO control ya. It's over when the finger tornado close ya.